Hello, I'm Clara Hermit and welcome to Mould on Markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you?
Not too
it's
bad
good to see you again.
Thank you.
Pleasure.
What is it that advisors and their clients should be thinking about at the moment?
It's back to those all-powerful, omnipotent central banks who continue to dominate market attentions. We've got the Federal Reserve and the Bank of England minutes on Wednesday the 17th.
So what are the markets looking for?
OK, well, the Bank of England has, in fairness, already said no change to policy, 0.5% interest rate, £375 billion of quantitative easing. So in that respect, it's kind of, a small earthquake in Chile, no British people injured. But the key here is the nature of the vote and the language used in the minutes, the right above the meeting. For the last 4 meetings, the vote's been 7-2 in favour of doing nothing, with Mr Wheel and Mr McCafferty voting for an interest rate increase. Now, the chart behind us shows the Monetary Policy Committee's voting history since 2007. Bars above, vote increase, rate increase, bars below, rate decrease.
Now, the Bank of England's issued a report saying that it thinks that the country is ready and could deal with an increased rate.
Yeah, particularly UK households, it said that a 2 percentage point increase in base rates to 2.5% wouldn't cause too much economic difficulty. However, George Osborne's autumn statement is a timely reminder that the government, Britain as a nation, is still potless and its debts are actually still going up. So households might be able to take higher borrowing costs with a little bit of austerity of their own, but the government, the country, I'm not so sure. And that's why the market's not really pricing in much by way of a rate rise in 2015. Certainly no action expected before the May general election, and the first 25 basis point increase not penciled in until Q4 2015.
Okay, so what about the Federal Reserve?
Again, I think the expectation is there'll be no fresh news in terms of the interest rate, 0.25%, no additions to QE. The key again is what the language is, the statement is, and will rates staying for a considerable time be left in. Now, we know, looking at the charts behind us, Q3 GDP is good, jobs growth is good, but inflation and wage growth are still quite subdued. It's not a rip-roaring recovery yet, and Chair Janet Yellen will be aware of that. And also what's happening in Sweden, of all places. Now, the Riksbank has just cut interest rates to 0. The Swedish Central Bank actually began to increase its borrowing costs 3 or 4 years ago and has backtracked, just like Australia, New Zealand, Norway and the Eurozone. So the Fed will have learned from that possibly, won't want to go too quick. And bearing in mind that, the weak yen, Japanese QE, possibility of European QE, the strong dollar, the markets aren't again expecting the Fed to do too much, too fast in 2015.
Okay, thank you, Russ.
Thank you.
Thanks for joining us, and we'll see you next time. Goodbye.